Assalamu alaikum. A very good day to you. And at first, I would like to provide all types of praise for the Almighty Allah who has given me a chance to join such like a digital platform. And today, I am here. I am Muhammad Mohammad Hussain, lecturer, Department of Accounting, Government Hussain Swiss the College, Magura. And today, I am going to take a session. And today's topic is risks and return. Risks and return. We know very well risks is the combination of hazard measured by the probabilities, and return means benefit. That means when we will take the risks, we will expect our expected benefits. So where there is a question of risks, there is a question of benefit, and benefits means return. So risk is the combination of hazard measured by the probabilities. Let's go to a slideshow for better understanding. We will find the different financial products, and such as fixed deposit bonds and shares give the different returns. Why do the returns differ? To answer this, we must understand the idea of risks. An important principle of investment is higher returns entails higher risks. Risks drives the returns on assets. A fixed deposit earns the lowest returns because they are considered the safest. The shares have the highest expected returns as they are most likely risky. So investment grade bonds have the expected returns lower than shares because they are less risky than shares. In investing, there is no rewards without risks. If investor offers higher expected returns, it will generally have the high risks. Suppose investment has an expected returns of 3%. If investment performs better than expected, actual returns will be above 3%. If it performs worse than expected, actual returns will be below 3%. Actual returns will be 3% only if investment outperforms is expected. So, means that its expected returns can differ from the other things. The difference between the actual and the expected returns is risky or voluntary. A simple statistical measures for risky is standard deviations. The larger standard deviations larger than overall risks for investment. Compare the investment A and B, which have the same expected returns of 3%, as B has the lower standard deviations than A. It will give a higher returns to volatile ratio, known as the Sharpe ratio. Investing, we aim to maximize the Sharpe ratio, which maximize the returns for the same risks, or minimize the risks for the same return. So further, be very successful in investing, you must understand the risk appetite. Assume your risk appetite on 3 dimensions: needs, ability, willingness to take the risks. If you have planned to retire by 40%, you would be need to generate the high returns. It will allow earlier retirement. If you have independence, you are able to take risks likely to be the lower than someone with no dependence. If you have the need and able to take on the risks, but if you find out unselling after buying a risk stock, then willingness is low. You may want to consider the investment with a lower risk profile, such as investment grade bonds. So amazing investment are choosing a roller coaster ride. If you choose a wider ride, then you can actually. If you likely to want to get the offer the right way, as is cascade when it dives. Similarly, if you have the investment that they are too risky for you risk appetite, you may panic and quit them permanently when the market dives. So the key to successful investing is the ability to stay invested. If you get off the roller coaster halfway, you could lose your investment. By staying invested, you may also ride out the myth. So it is time for us to calculate the math on common stock. So before it, we have to know what is the common stock. Shares owners who shares whose owners have the last claim on the corporation assets and liabilities. Shares whose owners have the last claim on the corporation assets and liabilities, but who have voting rights in the firm. That means shares whose owners have the last claim on the corporation assets and liabilities and who have a voting rights in the firm. So it means common share or common stock. So for calculating common stock, we have to calculate TR, total rate of return. Here D1 means current dividend, P1 means current market price, and P0 means base price. And we have to multiply by 100 for getting the percentage. So similarly, for calculating bonds, the similar formula we have to use. But in place of D1, we have to input the I1. I means interest. Okay. And for warrant, cash receipt. In place of I1, we have to input C1 for calculating warrant. So warrant is just like a bond, but there is no obligation in this particular cases. So it will be clear step by step. I hope so. You have to stay with this video and you will understand all things at the same time, part by part. And the math will be very clear to you for better understanding. So, dear participants, at first we have to calculate common stock, then bonds, and even after that warrant. So for it, we have to see the video very clearly so that you may understand very easily in what way we have to do. So it is for bond calculation and it is for warrant calculation. The formula is for warrant calculation. For common stock we have already said that we have to use D1 and in case of warrant C1. So this is the formula, the same formula. So here D1 means dividend per share and P0 means beginning or purchasing price, that means base price, and P1 means ending or selling price, that means ending price. Okay. And I1 means interest received at certain period for bond. For calculating bond, we have to use I1. And in case of C1, we have to use cash received at a certain period. Cash received at certain period. So, in this particular case, a total rate of return for common stock. We have already said common stock we have to use. Common stock means shares whose owners have the last claim on the corporation assets and liabilities, and who have the voting rights in the firm. So here there is a sample math for you and for better understanding. Here Mr. Noam. So total rate of return. Mr. Noam bought a share of Golden Sons Limited on July 6, 2009 for Taka 600. He received a dividend of Taka 30 at the end of the year and then sold share Taka 680. 680. So here dividend 30, current dividend 30. That means D1. I have already said. And 60, and here 600 is the base price. That means, and 680 is the selling price. that means current price. So requirement, calculate the total rate of return on investment. That means how much benefit you will get on investment. So in this case, the important things investment. Another important point is rate of return. So again, we have to observe the formula. D1 plus P1 minus P0 divided by P0 multiplied by 100. So let's go to the solution. Total rate of return D1 plus P1 minus P0 divided by P0 multiplied by 100. Okay, 100. In this case, what is the D1? 600 is the best price. That means P1. 600 is the P1. Okay, and D1 30 current price in this case. So current price P1 680, D1 30, and 680, 600, and 600 is the best price. Okay, 600 is the best price. So P0 D1, we have to put the figure that we have already got from the respective figures of math. So the answer is okay. So Johnson and Nicholson is a paint company, has the following dividend per share, and in this case DPS, dividend per share, and market price per share. So for the period 1987. So in this case, we have to calculate another math, total rate or return and investment. Johnson & Nicholson, a paint company, has the following dividend per share, DPS, and market price per share for the period 1987 to 92. We know very well, for calculating rate of return for common stock, we need base price, current price, and dividend, base and current. But in this case, if we want to calculate 1987's total rate of return, it is not possible, because in case of 1987 there is no base price. So here only the current price is shown, and for the season of being, we have to calculate from 1988 to 1992. So 5 years will be completed in this case, and we can calculate the average annual of Johnson's shares for the last 5 years. So let's go to the respective maths. So Johnson & Nicholson, a paint company, has the following dividend per share and market price per share, NPS, for the period, DPS and NPS for the period. So in this case, the given figure DPS and NPS, year 1982, 1992, and DPS from 1.53 to 3, and NPS 31.25 to 154. And you have to calculate the annual rate of return, average annual of Johnson's share for the last 5 years. So in what way we have to calculate? It is very easy for you to understand. Just we have to maintain a step by step, and you have to follow the math, and at the end of the session you will understand all things at the same time. So annual rate of return. Annual rate of return for common stock we know very well. What is the formula? The formula is D1 plus P1 minus P0 divided P0 multiplied by 100 for getting the percentage. Multiply the percentage. In this case, we have to calculate from 1982. I have already said that it is not possible to calculate 1987 because there is no base price. However, for better understanding, we have to calculate from it is 31.25 is the base price of 1988. So this is the system. So annual rate of return we have to calculate at this moment. 1988. So let's go to the solution. Calculate the annual rate of return for dividend. We know the rate of return in this case so here for the year 88 the formula is has already shown in front of you. Here 1.53 DPS, that means dividend, current year's dividend, and current year's MPS, current year MPS is 20.75, and P0 in this case 31.25. That means the previous year's is the base, 31.25. So base price is the same, so you have to divide it D1 plus P1 minus P0 divided by P0. So in this case the same figure, 20.75 is the current and 31.25 is the base. So you have to divide P0 here, 31.25 for 88. The formula is, and at the end of we have already calculated minus 28.70%, minus 28.75%. Now it is time to calculate for 89, for the year 1989. The same formula we have to use. So in this case, look, 1.53 is the current dividend for 89. Am I right? 89. Current dividend is 1.53, and current market price for the year 89 is how much? 30.88. 30.88 is the P1. 30.88 is the P1 for 89. So we will put in place of P1 30.88, and P0 in this case, P0 will be the previous year. That means the year of 88 is the previous year. That means base price. So in this case base price is 20.75. So P0 we have to put some 20.75, and multiply by 100. So in total we will calculate directly what will be the figure. Figure will be 11.66 divided by 20.75. Okay, and multiply by 100. So we'll get the percentage. What will be the percentage? 56.19%. Okay, so this is the result for 89, rate of return 89. So similarly, we have to calculate for the year 99, 90, for the year 90, 1990. The same formula we will just copy and we have to the paste here. So same formula we have to use. Just we have to put the value. In this case, the current dividend for the year 90, 1990. The amount is given here on the table 2.00, 2.00, 2.00 plus for current market price for 1990, current 1990 we would put 67.00. So base price for 90 it will be 30.880. That was put on previous year 30.88. So in this case P0 will be 30.88. So I will not calculate the more. So direct figure I will put in for a quick presentation 1, 2, 3, 123.45%. So now it is time to calculate another year for the year 90. For the year 90, we will calculate now for the year 1991, total rate of return for 91. So in this case, the current price in this case 91, it is the same figure 2.00. So there is no need to change. Okay. Even after that, for current market price, how much amount? 100. That means 100.00. In this case, the base price, that means P0, that means the previous year's amount is how much? 67.00. 67.00. So 67.00 multiplied by 100 will get the result in total. What's the amount will be the total at the end? 52.24%. So hope so. It is very easy for you to understand or calculate. All right. So similarly, we have to calculate another last year. For the year 92. For the year 92, we will get so 92. So it is time to understand the current dividend 3.00 for 92. Okay, 3.00. So for P0, that means current market price 54.00, 54.154.00, and base price, that means the previous year is 100. That means P0 means 100. Okay, P0 means 100, and you have to multiply by 100. Okay, and so in this case we'll get the result. Now after calculating, we'll get the result by percent 57.00%. So this is the total rate of return, and we'll start it from 88 and we have to finish at 92. That means for 5 years we get separate percentage. So here there is a formula. We know average rate of return. Average rate of return. Average rate of return means here rate R bar. We will use R bar. R bar. R bar means average rate of return. Okay. So here we will use the formula. Average rate of return means uh, summation of 5 years divided by 5. It will be the figure. Okay. It will be these are the figures. So these are the figures we have to put from 88 to 92. So in 88 we get we have got minus 28.70, and in 90 even after that we'll get 56.19, and even after that 123.45, and in fourth year we have got 52.45, and at the end of 5 year we'll 57.00. Now in total we'll show by percentage by within the bracket. Okay. So outside the bracket we will show the percentage, so it will show the whole figures percentage. Okay. You, and here how much year? 5 years. So we have to put 5, and even after that it will be get the result. How much amount? The result will be 52.04. Hope so you understand all things at the same time. So it is the answer. So for your better understanding, this is the two maths for in front of you for better understanding, and I hope so it is very easy for you to understand all things at the same time. So dear learners and dear friends, now it's time. I will suggest my beloved learners to subscribe my YouTube channel so that you may get promptly my upcoming videos. And here my YouTube channel's name is MD Mobatashan, and subscribe my channel for more upcoming videos. So this is the facts in front of you.